Market psychology. The market has a way of making smart people do foolish things, buying at the euphoric top, panic selling at the exact bottom. If charts were the whole game, mathematicians would own the world. The real battlefield is in your head. Markets are not just numbers moving on a screen. They are millions of people making decisions while the future is uncertain, and humans are emotional. Two emotions drive markets more than almost anything else: fear and greed. Greed makes people chase prices that are already rising. When everyone around you seems excited, it feels safe to join in. Fear does the opposite. When prices fall and panic spreads, people rush to sell before things get worse. That is why markets often overshoot in both directions. Bull runs can go much higher than logic suggests. Crashes can fall much lower than expected. Human emotion pushes prices beyond what calm thinking would normally support. In crypto, two emotional forces appear again and again. The first is FOMO, or fear of missing out. You see a coin rising fast. Social media is full of screenshots and success stories. It feels like everyone is making money except you. FOMO makes people buy late, after a big move already happened, and very often those late buyers enter at the worst prices. The opposite force is FUD. Fear, uncertainty, and doubt. This usually spreads through scary headlines, rumors, or panic online. Suddenly, everyone believes the market is doomed. People sell quickly just to escape the stress. And here's the important part. Both FOMO and FUD feel completely reasonable in the moment. That's what makes them dangerous. Emotions rarely announce themselves as emotions. They feel like logic. Markets also tend to follow an emotional cycle. It usually starts with optimism, then excitement, then euphoria at the top, where people become extremely confident. After that comes anxiety, denial, fear, and finally capitulation, where people give up after heavy losses. Then, slowly, hope returns, recovery begins, and the cycle starts again. Historically, euphoria has often appeared near market tops. Maximum fear has often appeared near market bottoms. The crowd is usually most confident right before it is most wrong. Quick question. There's a famous index that measures crypto market emotion daily. What do you think it is called? Think about it. The answer is coming up. It is called the Fear and Greed Index. This index combines things like market volatility, price momentum, and social media activity into one score from 0 to 100. 0 means extreme fear, 100 means extreme greed. This tool is not a magic trading signal. It doesn't tell you exactly when to buy or sell. Think of it more like a mirror for market emotion. If the index shows extreme greed and you suddenly feel like putting all your money into a trade, that feeling deserves a second look. The same goes for extreme fear during a crash. So, how do you build emotional discipline? First, create a written plan before entering any trade. Decide your entry point, your exit point, and the maximum amount you are willing to lose. Second, keep your trade sizes small. Small risk usually creates smaller emotional reactions. Third, avoid checking prices constantly. Watching every small move can increase stress and lead to impulsive decisions. And finally, journal your trades. Write down not only what you did, but also how you felt. Emotional patterns repeat just like chart patterns. To recap, fear and greed move markets more than logic. FOMO buys tops and FUD sells bottoms. The emotional cycle repeats again and again, and a written plan is your best defense. Follow us for weekly crypto education made simple. This content is for educational purposes only and should not be considered financial or investment advice.